the national grid operator and tying in many ways with the states, identifying these renewable energy zones around Australia where wind and solar capacity or resources is good and grid connection has great potential, and then trying to get generators and developers to build in a cluster, if you like, around a particular connection, rather than it just being so opportunistic, which has been really the theme so far in Australia.
Hello and welcome to Energy Unplugged by Aurora. This podcast features various experts from Aurora having in-depth conversations with key industry leaders, policymakers and academics from all over the world. It explores the hottest topics across the energy market and gives a unique perspective on major energy issues.
Welcome to Energy Unplugged. I'm Hugo Batten, Managing Director of Aurora Australia. We're very much looking forward to today's discussion. We have Ian Learmonth in today, the CEO of Australia's Clean Energy Finance Corporation, the CEFC. Ian's had a lengthy career in energy and infrastructure across the globe. He spent time in Hong Kong, London and Sydney. He spent a lot of his career at Macquarie, but also at NatWest and Social Ventures Australia. He's a product of the University of Queensland. Ian, welcome to Energy Unplugged. Delighted you can join us.
Thanks, Hugo. Lovely to be here.
Can we just start off at your career prior to the CEFC? You studied commerce and law, like a lot of promising young Australians. How did you end up at Macquarie? What was it like when you joined 20 or 30 years ago? And what kept you there for 20 years for your career?
Yeah, thanks, Hugo. Yes, as you say, commerce law, the combined degrees were very popular, still are. Australian universities are great ones for double degrees, and commerce law is one of those very popular double acts. So yes, did that in Queensland. But interestingly enough, when I first came to Sydney looking for a job, and many Brisbane people of my era came to Sydney to look for jobs in law or financial services, because Sydney was the big smoke and Brisbane was still, developing from its old country town reputation in the late 70s. I actually wanted to be a lawyer. I wanted to be a music lawyer. I'm very one of my other passions besides the clean energy sector was music. And I met one of the big Sydney music lawyers, and he said, you should think about, with your commerce degree, working for one of these new deregulated banks, because the music industry is a really tough place to be. And the clients, the talent themselves, they often can't pay the bills. It's pretty tough. So have a think about that. And anyway, I took his advice, and one of those new licensed Australian banks was Macquarie. So yeah, all those years ago in 1987, I joined Macquarie. And it was a very different time, of course. There was something like 420 people at Macquarie when I joined. I mean, I know that's hard to imagine now that there are nearly 15,000 across the globe of good Macquarie foot soldiers. But back then, 420 or so people, almost entirely in one building in Sydney, 20 Bond Street. There were small offices in Sydney, in Melbourne and Brisbane, maybe one international office, be it London. And it was a very different place, but even then had a reputation for being innovative, hiring great people. And had the senior management had incredible backgrounds of Harvard MBAs, and those days probably less common in Australia. So I was very attracted and interested to work in this new and exciting investment bank, being Macquarie. It was, I guess, probably was even referred to as a merchant bank back then. And over the 22 or so years, and I had two stints at Macquarie. I left Macquarie after 9 or so years when I went to Hong Kong, when I worked for NatWest for a couple of years, and then I returned for another 13 or so, both in Hong Kong and London, and then back in Australia. It was always evolving, Macquarie. It was always, kind of taking on new frontiers and getting into new businesses. And look, it gave the deal side of the business, the transactors, the originators out there across the globe, people who were, the fee generators. It gave them a lot of latitude. It was one that it said, you define the strategy, you go out and find all the deals, and we'll have a very tight risk framework back at HQ. And that was really the model. And I think that sense of entrepreneurship really kept me interested for all those years.
Mm. And I mean, obviously the CEFC is a very different type of institution with a different set of stakeholders, but is that what you took from your time at Macquarie there, that kind of entrepreneurialism, or is it a different, set of lessons you took to the CEFC?
Yeah, it's interesting. I definitely do carry some of my old Macquarie characteristics and try and instill them or work with them at the CEFC. The thing, I guess, one of the big differences, of course, with a statutory corporation, and that's what the CEFC is. It's a federal government corporation. Is that that sort of very open strategy that Macquarie had to tackle different markets and different regions, countries around the world. Is you don't quite have that there, because the act that set up and in some ways regulates the CEFC at a very high level says you must invest this $10 billion that you've got in Australia, and you must invest it in renewable energy, energy efficiency, or low emissions technologies. So you've got some constraints in that sense. You can't go and buy the New Zealand equivalent or go off and do offshore wind farms in Taiwan. You've got to stick to Australia. But having said that, within the mandate that we've got, and it's a very broad and flexible one because we can do debt, we can do equity. There is enormous room for an entrepreneurial approach. So, there's still, and there's quite a few of the old Macquarie alumni floating around the CEFC. I do think we try and instill that, those characteristics into the organisation.
So perhaps now's a good time to turn to the CEFC itself. A lot of our overseas listeners are in Europe and the USA. So just for them, could you perhaps talk about how the CEFC came about, what was the genesis of it, and perhaps using the UK's Green Investment Group as a comparison, kind of how does it differ from that, or how is it similar in your view?
Certainly. So the CEFC came about 8.5 years ago when the Labor government here in Australia were elected, and at the time they had a sort of a minority position, and they needed to form an alliance with the Greens to form a government. And the Greens, part of the conditions of that coalition, one of them was to establish a green bank, and a very large and ambitious one, relative to Australia's, I guess, scale. And that's how the CEFC came about, and it was established on the basis of $10 billion, so 10 billion Australian dollars, would be available to invest, as I say, broadly across the clean energy sector in debt and equity, so not a grant maker, but it had a very broad mandate in the sense that it wasn't confined to particular technologies. It was really just about an investment vehicle that was there to kind of lead the market, invest in places where the private sector wasn't confident enough, or didn't understand a particular technology, or didn't feel it was sufficiently developed. So it was filling gaps in the market. It was also established to try and crowd in private sector capital. So, I guess every time we're going into these transactions in the first wave, and we've been at the first wave of grid scale PV and even the wind market and batteries and so on. We're trying to draw in third-party money because having 10 billion is great, but of course this is a multi-tens, if not hundreds of billions of dollars challenge. So we have to, of course, tap into the private sector. So crowding in was a very important part of it. It's a perpetual fund or corporation, so it's not. It doesn't have a 10 or 15-year life, and then the money has to be ultimately recovered and returned to government. It's around as long as the CEFC Act is around. And the Green Investment Bank, as it was originally, and then it was sold, of course, to Macquarie Group and has changed its name to Green Investment Group. When it was established by the UK government, I think the intention was always that it would be ultimately sold to the private sector. So I think that was one big difference. It's predominantly, the UK version has been more equity orientated. We're about 80% debt, 20% equity. I think the GIG, as it's known now, was much more an equity investor, and it had certain technologies that the UK government wanted to focus on, including waste to energy and so on. So there were different characteristics, but in some ways many similarities. It's £2.5 billion. So it was a large amount of money, and it was there to sort of break down barriers of investment into this sector. And it's done offshore wind, and it's done waste to energy and so on. So and we have a great relationship with those guys. We talk regularly. We represented respective conferences together, know them well, and I guess being an ex-Macquarie London person, I'm very well known to the Macquarie executives who were part of the acquisition deal, who are now leaders in that area. So lots of similarities in a way, but yes, we will continue to be owned by the Commonwealth government here in Australia until there's some major change in plan.
Yeah, and you were kind of getting into that in terms of crowding in, and I was reading the annual report where the CEFC has actually exceeded its goal in terms of attracting relatively more private capital for each dollar it puts into a project. I think 3-1 against a target of 2-1. How do you think about and manage the inherent tension in a statutory organisation like the CEFC of investing in projects where you're confident you can generate a return versus not crowding out private sector debt? And you've obviously got a terrific team that looks in detail at these business cases. But how do you kind of think about that? How do you stay at the kind of bleeding edge of new technologies and areas?
Yeah, no, it's a good question, and it's not always straightforward. And the dynamic can change over the course of the transaction. We can support a new technology in Australia like waste to energy, or the early days of when we were financing grid scale solar, and the project may not have had any offtake agreement for its power. So it was very difficult for banks to come into those sorts of deals. And you want to support them. You want to bring the price of the technologies down. You want to build up the supply chains, and then contracting might come along even in the course of the 18 months of getting the final planning approvals and so on. And then there's a bit of a question: do you stay in? Are you giving confidence to the incoming bank? So therefore you should stay in. So it's really a question of judgment, and I think we've got it right most, if not, I'd like to say all of the time. I mean, I'm sure there'd be people who might look at the occasional club deal that we've been in, or syndicated facility that we might have stayed in and thought, why are they still there? But we'd always have I like to be very strict on this point, and the team are very good about it. But we're always there for a reason. We're giving other investors that confidence, and that's across a range of different things. We've got a clean tech business, and we'll support these early stage Australian technology companies, and I think that helps others come in, even though we're drawing in other investors. But yeah, look, it comes down to weighing up all those factors, and if people pipe up, if banks get on the phone to the CEFC or someone and complain, we take that very seriously. But in my time, and I've been the Chief Executive Officer at the CEFC for about 3.5 years now, almost no complaints from the banking community. So I think we're doing a pretty reasonable job.
Mm. So in terms of areas of focus for the CEFC moving forward, and again, for our overseas listeners, renewables have, in a remarkably short space of time, as in many places of the world, got very cost competitive. You hear Australian solar being delivered at 40 to 45 Aussie dollars, and onshore wind not dissimilarly because of the excellent solar and wind resources in mainland Australia. You've also got then state governments stepping in to provide various subsidy schemes for renewables. So it feels like that is a kind of maturing or mature space in the market. The CEFC focusing now on different technology classes, but also has got a kind of new part of its mandate in terms of the Grid Reliability Fund. What technologies are you guys focusing on over the next 5 or so years? Could you kind of step us through the major ones?
Certainly. And look, as you say, we were, over the last few years, very actively involved in supporting the growth and increasing maturity of the solar PV and the wind market here in Australia. And now we're kind of moving on to that next frontier, that next stage, which of course is storage. And we've been involved in both supporting household storage and the proliferation of that uptake across Australia. Australia, of course, has an extraordinary number of people who have rooftop solar. So if we can add batteries to the rooftop solar, there's an incredibly powerful story there. But also grid-scale batteries that are coming into Australia's electricity grid. And we're involved in the first project financing of a grid-scale battery here in South Australia, in fact, which was the Tesla Big Battery at Hornsdale, and that was a 50% increase in the capacity of that battery. And we have a number of large-scale battery projects in our pipeline. We've probably got ones that we'll announce early in the new year. So there's large-scale storage and pumped storage. We're also working on those projects. So there's both the battery end, and then Australia, of course, is trying to get up 6 to 8 hour, much longer and larger scale storage through hydropower. And so that's part of what we're focused on. And then, as you say, working and using our capital to improve the reliability of the grid, because the Australian grid was not built for a distributed energy resource. It was built around coal-fired power stations, and there's a real catch-up in going on here in this country, where there's been all the solar and wind that's being built out at a rapid rate, and the grid's sort of catching up with that. And so Australian, the federal government is planning to give us a further $1 billion to invest in grid reliability and security.
Just to jump in there, Ian, I think that is, when I look at where Australia sits in the kind of energy transition, some areas it's potentially lagging a little bit, but those grid issues, I think, are where it's at the absolute kind of bleeding edge, both in terms of some of the issues that are coming up in terms of system strength from a long, thin grid, but then also some of the solutions that are emerging, both technology and kind of market-based solutions. And the grid modeling we do in Australia, we're absolutely starting to apply to European markets where it hasn't become an issue yet, but may well do as you're losing inertia on the system with more and more renewables entering. So I think Australia is genuinely quite unique in the role the grid is playing in the energy transition.
Yeah, absolutely. I think there are a couple of unique aspects to Australia. There's this grid issue, and as I say, we're trying to put capital. We've just announced our first investment in the grid, so that's a connection to the Snowy 2.0 project, which is a government-owned 2,000 megawatt pump storage project. So we're investing in some unregulated transmission to help support that particular project, but we've got lots of others in the making, interconnection across states in Australia, and even potentially, across the Bass Strait, which links Tasmania to Victoria. So there are big plans across the country to improve the situation with the grid, but it takes time, and it obviously takes a huge capital investment. And we'll be part of that solution, but equally, there's the regulatory framework that'll need to be upgraded and improved to account for this. And this, as well as the Commonwealth government, various state governments in Australia have got their own kind of plans and ambitions around improving the grid. The other areas I'll mention, Hugo, which the federal government has directed us to turn our attention to. Because they've set up their own, what they call their technology roadmap, as well as large-scale storage. They have directed us to invest in hydrogen. Of course, hearing an enormous amount about hydrogen across the globe. Australia wants to be part of the hydrogen story. In clean hydrogen, we've dedicated or allocated $300 million of our portfolio to projects in that regard. So we've got the first wave of hydrogen projects here in Australia, electrolyzer as driven by renewable energy, in some cases putting that hydrogen into the gas system. So hydrogen's an area, working with industry to produce green steel and green aluminium. So industry, of course, is a big emitter if we can address some aspects of that. And carbon capture and storage, the government would like to build out here in Australia. We haven't been able to do that to date because our Act precludes us from doing it, but I think the government has plans to remove that. So there's some of the other technologies that we are focusing on as well.
Could maybe just to double click on storage, because as Aurora does a lot of work in the space, in the States, in Europe and Australia as well. Storage investment cases are often complex. They rely on intraday price volatility. Still, ancillary markets drive a significant proportion of the value. So AEMO, Australia's system operator, produces what's called an integrated system plan. They identify somewhere around 10 to 12 gigawatts of storage requirement through the 2030s. So there's clearly a system need there, and Aurora's modelling comes to not dissimilar conclusions. So I think everyone understands the system need, but getting comfortable on individual investment cases is challenging. How does the CEFC think through the economics of storage on any given project, I suppose?
Yeah, and you're right. It is a challenge. You've got to look at, like all good project financiers in this case, and they invariably have been project finance opportunities. What are the projected cash flows over the next 10 or 15 years for for that storage enterprise? And what views are you taking on the volatility of power prices to make that one of the revenue streams, and what other revenue streams are available around frequency control? And those frequency control markets are constantly changing in Australia, particularly as the rules will change over time, and as more batteries come into the system, they will potentially erode the value of the previous battery that was installed. So there's a lot of assumptions that you need to make over a significant period of time. So we've spent a lot of time, and we're working with your team, Hugo. It's been hugely helpful. But most of that, the first wave of large scale batteries in Australia have also had some kind of contractual support from potentially a state government to take a bit of the sting out of the decision that you've got to make around those cash flows. But I suspect as prices come down for lithium-ion batteries, government support will want to step back and hope that investors and financiers are going to be able to take a view on projected cash flows and revenue streams coming from. So we're sort of seeing our first wave of ones where they are coming without a grant or government support, and that's where we're really having to think very long and hard about how we structure the debt. We get paid down as quickly as possible in the more comfortable, early, visible 3 to 5 years, and take a bit more of a view on the distance. But yeah, look, that is the big challenge with storage, no question.
Yeah, you touched on state governments there and the various support they've provided. I mean, Australia, I think every market feels like its policy setup is in a unique state of flux because the energy transition is moving very quickly. But I genuinely think Australia is unique in how fast the policy announcements have come over the last 12 to 24 months. So again, for our overseas listeners, just as an example, you've had a series of federal government announcements where they're looking to inject more reliable capacity, dispatchable capacity into the market. The state governments have typically been more focused on renewable support, but you've then got this overarching program that the Energy Security Board, the ESB, are running to look at post-2025 market reforms in a more integrated, holistic way. So New South Wales just by itself has introduced almost a kind of UK-style EMR set of reforms where it's support for renewables through underwriting, support for dispatchable capacity, and then additional transmission being built. So in short, a huge amount going on. As an project financier, how do you think and quantify all these policy risks, and how does that factor into your decision making? I suppose.
Yeah, look, it's an interesting landscape, as you say. We balance the federal government's policies and their direction with the very hands-on role that the states are playing, and we're obviously very pleased that New South Wales has announced what is up to a $30 billion investment in the electricity infrastructure system, and that's 12 gigawatts of renewable energy to be built over the coming years, and 2 gigawatts of storage. So we welcome all of that, but I guess once again we kind of come back to do the deals that we then see that come out of it, and be the various developers and sponsors that will tap into these initiatives. They'll come to us, and we'll kind of look at them and we'll just evaluate each of them on their merits. Do they need the CEFC? Are they fully contracted with the state government, and they're trying to just get some good pricing or some long tenor out of the debt when they really could be banked far just as easily with the private sector banks? So we sort of still look at the deals as they come up. We stay very close, of course, to the regulatory environment, and we talk very actively with the rule makers and the evaluators and the grid operator, AEMO, as you say, because when you're involved in transmission transactions, large scale pump storage, the policy decisions you can often live and die by. But yeah, look, it's a fascinating time. We're kind of going into that now second wave of build out of renewables, and but I think it's being it's more thoughtful. It's the necessary strategy around the grid, and particularly, and something that's probably interesting for your listeners, Hugo, is the national grid operator, and tying in many ways with the states, identifying these renewable energy zones around Australia where wind and solar capacity or resources is good, and grid connection is has great potential, and then trying to get generators and developers to build in a cluster, if you like, around a particular connection, rather than it just being so opportunistic, which has been really the theme so far in Australia.
And correct me if I'm wrong here, because I haven't kind of followed the legislation super closely, but the federal government was talking at least about changing the CEFC's remit to include kind of fast ramping gas generation. This has obviously become a pretty contentious topic. To some degree, you had debates about the role of coal moving forward, but that seems to be kind of relatively more settled. And now it's about the role of gas. And Australia's chief scientist, Alan Finkel, has received some criticism for saying there is a role for gas over the next 10 to 20 years. I think his comments were taken a little bit out of context. He was trying to make, I think, a more subtle point around the need for backup generation for when wind and solar output is low, not suggesting there are significant volumes of new gas, but that it was important to think about system security and more weather-dependent systems. How do you think through the role of gas in Auss's energy transition? And without kind of commenting on the debate that's happening in Australia, do you think there's a kind of way to bring together the warring sides to get to a sensible outcome?
Yeah, look, it's interesting. I guess Alan Finkel and probably the AEMO, the grid operators' blueprint for the next 20 years, what we call the integrated system plan. It is fair to say that doesn't have an increase in its base case, doesn't really have an increase capacity for gas in the system. There, of course, will be around for a number of years because it's providing important firming capability to the grid. And I think gas is, without question, is going to be around for some time in Australia. And the big question is what's going to provide the ongoing and increased firming need to the big build out of renewables that we're talking about, and particularly stimulated by some of the states and so on. And part of that, of course, will be gas, but equally, the battery storage that we were talking about and pump storage when Snowy 2.0, 2,000 gigawatts of large-scale storage comes on in about 6 or 7 years. So I think there's a lot of other sources of firming coming into the system. It hasn't been an obvious place for us to play. Occasionally, we get, let's say, large wind operators who come to us with proposals where they might say, look, we can build out all this additional wind or acquire additional wind farms and so on, and we can service our customer base, as in sell firm, clean, green energy to them, but we might need to also invest in some gas peakers, for example. So we've kind of been pragmatic and looked at a couple of those deals, haven't done any to date. But where gas can be used in firming and unlock more renewables and provide a firm, dispatchable, clean, green product, that's of great interest to us.
Makes complete sense. Maybe just to wrap it up on Australia's energy system then, Australia, like most jurisdictions, does have big vertically integrated utilities, which are colloquially referred to as gentailers in Australia. They, like a lot of vertically integrated utilities in the energy space, the energy transition has been challenging for them to negotiate. In Australia, they have big coal plants, throughout the country that are increasingly having their economics eroded, particularly during the middle of the day when solar output is high. The duck curve is becoming increasingly apparent in Australia. Also, challenges on the retail side from kind of smaller, often green, startup second-tier energy retailers. Perhaps putting your kind of Macquarie hat back on, what do you see as the strategic options available to the gentailers to help negotiate the energy transition, and how can they adapt and kind of continue to thrive over the next 20 years?
Yeah, look, I think they're very conscious of where they're at. They have huge franchises to protect. They have, they have differing blends of generation capability, but they all have some component of renewable energy in their mix. They are all acutely aware that in terms of new generation, that's going to be the cheapest, but they also, they need to provide firm dispatchable power to their customer base, be it retail or C&I. So, I don't have any magic answers for particularly the three big gentailers in Australia. I always watch them with much interest, and they're all very ably led and capable. And they know that the coal-fired power stations, of course, are they're going to retire. They want to stay relevant. They want to be. The consumer, particularly the retail consumer, I think, is increasingly looking for a clean energy solution, and so they're making investments in technology so that they're not left behind. Back to Australia's rooftop capability. 2.4 million rooftops in Australia have solar on them, and therefore, people when batteries become cheaper, and at the moment, battery uptake's been okay, but quite limited because the payback's a bit too long for the average Australian household. But once people kind of are starting to put in, batteries as just as a conventional thing to do, and they're able to sell their power into the grid, and, as well as generate it on their rooftop. There's increasingly a worry for those big gentailers, for their retail book, of people just kind of disconnecting and going off grid. So Australia's again at the bleeding edge of some of these issues, and I think all the big gentailers acutely aware of the direction the market's heading. Some of them are probably they're all approaching it a little bit differently, but I think they're wanting to make bets on the technology side as well, and I've seen some of those investments taking place. Look, no magic answers for any of them, but I don't. They're certainly not going anywhere soon. I think that their fight to stay relevant will continue for a long time.
Yeah, I think AGL announced plans for something like 850 megawatts of lithium-ion batteries. So they're clearly trying to break into the space and do innovative things. Ian, if we could kind of draw to a little bit of a close then. So this is something that John Feddersen started doing, our CEO, and I do quite like it. So I'm going to kind of give you a concept essentially, and then ask you whether you think it's over or underrated by the kind of wider market or energy intelligentsia. I think the best answers here are typically one word, but maybe with an explaining sentence to clarify your views. So, the role of markets in the energy transition, an over or underrated concept?
Underrated concept. It, at the end of the day, is the lifeblood of these projects. So without the right price signals being there in the market, nothing much is going to happen.
Terrific. The kind of value of individual corporations committing to net zero by 2050, over or underrated, do you think?
Possibly overrated. It's, yes, extremely important, but at the end of the day, I think large, particularly listed companies, will keep an eye on the bottom line, and those sort of projections, can be managed, if you like, but still extremely important.
Okay. And then finally, the likelihood of Australia getting to a net zero power system by 2050, do you think over or underrated by the domestic Aussie market?
I think, underrated in the sense that I'm extremely optimistic that we'll get there. I think, I think we're decarbonising at such a rapid rate in the energy sector, and I think if any sector is going to get to net zero early, it's going to be it's of course going to be the electricity sector, because so many of those other sectors are just so hard to abate, relatively speaking.
Yeah. And then one final question: is there anyone you read or listen to in the energy space that you can consistently think is excellent, relevant to the private sector? Is there anyone that springs to mind?
Look, there are a lot of great energy writers, energy wonks in Australia. The Angela McDonald-Smith, who's probably one of the kind of lead writers for the Australian Financial Review. I think always try and read her column. Has great insight. Been tracking it for years. Very thoughtful. And I think an important voice in the energy debate.
Terrific. Well, Ian, thanks enormously for your time. We've covered a lot, I think, in about 40 to 45 minutes. I know you're one of the busiest men in Australia's energy space. We're very appreciative of your time. Thanks again.
Hugo, my pleasure. Thanks for having me.
That was Hugo Batten, Managing Director of Aurora Australia, talking to Ian Learmonth, CEO of Australia's Clean Energy Finance Corporation. Do keep an eye on our podcast feed for more in-depth conversations with senior members of the energy industry. The best way to do this is to subscribe on whatever platform you use. Thanks for listening, and goodbye.